like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
There's a storm brewing on the horizon, and it's set to make landfall in the world of real estate. This is what Barry Sternlicht, billionaire and co-founder of Starwood Capital, had to say about the upcoming crisis for office buildings. And if you want to find out how you can survive this difficult time, make sure to like this video and subscribe to the channel for more videos like these. First, before you can really understand what's going on in the real estate market, you need to know how real estate prices and interest rates work together. Real estate is an asset that has a steady flow of money coming in. A set income stream is a steady amount of money that comes in every year. If you own an office building and your tenant has a 10-year lease, you know how much pay you should get during that time. Fixed income from real estate comes from these cash flows that can't be changed.
Pathetic to the situation of Jerome Powell, because you have a government that's spending money hand over fist, and then you have the Fed trying to break an economy. And I'm critical of Powell because, as you may know, they use a portion of the data they use is quite lagging. And they didn't see inflation when it was here. And then when they showed up late and big. They went straight vertical on rates. We had to increase rates. We should have done them much earlier. You shouldn't have had negative interest rates. You shouldn't have been buying mortgages into May of 22.
Here's what Sternlicht meant when he said that as interest rates go up, the value of any object with a fixed income stream goes down. A commodity is what traders call a thing like real estate. Any goods price depends on how supply and demand are changing at that time. We already know that the cash the building makes affects how much it's worth. But what decides how much rent you can charge for each of these rooms as the owner? It has to do with how many flats are on the market and how many people want to rent them. And it looks like the high demand for apartments could change very soon. You see, when we talk about monthly rent for apartment owners in an apartment building, we're also talking about something called strong fundamentals. This happens when there's more demand for apartments than there are apartments available. Now, for the past few years, the economy's been doing very well. Unemployment's been low, and the government's been pumping money into various programs.
Industrial logistics market, the hotel markets, those are all in good shape. But there's no question that the Fed has reacted dramatically to try to slow the economy down quite late, obviously. And that has impacted real estate values. Yields on properties are moving up to reflect this higher interest rate, and the supply of credit to the industry is curtailed dramatically. So I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
On top of that, home prices have shot up, making it tough for many people to buy homes, so they keep renting. All of these factors have created a bigger demand for apartments, driving rents higher. But things can change when a recession hits. During tough economic times, the demand for apartments often drops. People lose jobs and might end up moving back in with family or getting roommates to share the rent. And if that sounds like a tough reality for you too, make sure to like this video and subscribe to the channel for more videos like these. Anyway, in these circumstances, some people even face eviction, which is tough for both tenants and apartment building owners. Now, remember those strong economic times we talked about earlier? Well, during those periods, investors like to build more apartment buildings. But here's the thing, it takes quite a bit of time, usually 12 to 24 months, to go from planning a new apartment project to actually having people move in. And guess what's happening right now? In 2023, there are a whopping 560,000 new apartment units hitting the market. That's the highest number in 2 decades. So, with all this new supply, the balance between supply and demand is shifting. Prices are coming down. But here's the real estate twist. It's not just about apartments. There are 2 other areas catching the attention of experts like Barry Sternlicht.
The legal profession is probably target 1. Not far behind is advertising. When the machine is going to update advertising and keep bombarding you with more and more ads, with more and more offers until you take one. So humans won't be there. They'll be maybe guiding it, but it'll change advertising. It's another big user of space. Finance.
First, there's the office market. Remote work has changed the game. In some parts of the world, like Europe and Asia, offices are buzzing again. But in the US, things are a bit different. Fancy modern offices are still in demand, but older, less appealing ones in not-so-great locations are struggling. Some might even be torn down. Now, let's talk about houses. Sternlicht's company owns over 3,200 single-family houses in the US. Now, let's be clear about one thing. Housing has been in a bit of a roller coaster. Low interest rates have kept many homeowners from selling, but when those rates go up, people might start selling again. Wait, so what exactly is going on in the remote work market? Since offices are still a thing in Europe, rents are up and vacancy rates in the top European property markets, think Berlin, Frankfurt, Munich, are lower than 5%. People in those parts of the world are back in their offices, like we mentioned before. Now, back in the US, we've got two types of the office market. On one side, you've got those swanky ESG-compliant buildings. They're buzzing with life because, let's face it, they're just fun places to be.
Homes will be sold, like people will start because the mortgage will no longer be a reason to hold on to the house. And whether that will offset will probably be an increase in supply as the builders resume a more normal cycle. So maybe the housing market just stagnates for a while, but over time it's headed up.
But then there's the other side, the not-so-great stuff with cubicles, no natural light, and zero charm. Those buildings, well, they're struggling. In places like New York City, where office spaces are turning into ghost towns, there might be some creative solutions. Maybe they'll turn those empty spaces into mini-parks. It's a bit of a tough situation for those buildings, and not many people are optimistic about their future. That's also mainly because of the commute. Cities like New York or LA have a tough commute, and that's putting pressure on the whole work in an office idea. People don't want to spend hours driving in and out of the city every day. But a little recession might actually change things up. Sometimes challenges like this can clear up when the economy takes a dip, and people might find their way back to the office. Oh, let's not forget about the impact of artificial intelligence. AI is starting to shake things up in industries that used to gobble up office spaces. Most office workers these days aren't too keen on spending all 5 workdays at their desks. This shift in work preferences is seriously shaking up the office market. Companies just don't need as much space as they once did. It's a bit of a mess, really. The situation has gotten so bad that many office buildings, once bustling with workers, are now completely empty. Some might even face the dreaded wrecking ball. Take a look at San Francisco, for instance. Vacancy rates there are through the roof, nearly hitting 30%. That means about a third of all office spaces in the city are just sitting there, gathering dust. But hold on, not all office buildings are in the same place. They're divided into 3 categories, depending on factors like age, location, quality, and amenities. You've got your A class, which are the cream of the crop, the best of the best. Then there's the B class, pretty decent but not quite top-notch. And lastly, the C class, which, well, let's just say they've seen better days.
I expected him to tell me about some horrific investment he made and he lost all his money. He said, not selling my winners too early. And I think about that all the time. But human nature, even in running a stock portfolio, is to take your gains and hold your losses, hoping they come back to par. The same thing applies to real estate. You know, we want, we got a high IRR on this deal, we'll sell this asset, pocket the 47 IRR, and our bad deals, we'll just, hopefully we'll make our money back. And you know this from Carlisle, we spent all our time on the bad deals, and so I think that has been, we had a portfolio, a company that we were going to sell, and we made $900 million, and I said, we're not selling it. My partners were furious.
Now, here's the thing. The real trouble in the office market is mainly hitting those poor C-class office buildings. They're outdated, often stuck in less than ideal locations, and honestly, not in high demand. Some might even find it more cost-effective to say their goodbyes and tear those old buildings down. Now, let's talk about the housing market. Sternlicht's firm, Starwood, is sitting on a pile of over 3,200 single-family houses across the country. So it's safe to say they're keeping a close eye on the housing scene. That's because there's concern about whether the housing market is headed for a rough patch. You see, at some point, home prices might start coming down. But Powell's decision to raise interest rates has tightened the housing supply. Many people have locked in their mortgage rates, making them hesitant to sell their current homes. So, the supply of homes for sale has shrunk a bit. Okay, so when those interest rates start coming back down, it might be a different story. People might be more willing to sell, and you could see a surge in supply. But there's a catch. Builders might also ramp up construction as things normalize. So the housing market might not skyrocket, but it's definitely got some upward potential in the long run. So, to wrap it all up, the real estate market's future remains uncertain, and only time will reveal its true course. Stern Lake anticipates a rocky road for the next 12 to 18 months. But here's a glimmer of hope. He's been dropping hints about surviving until 2025. What does that mean? Well, if you can ride out the storm and make it to 2025, there might just be some fantastic opportunities waiting on the other side of this economic whirlwind. And if you're willing to wait it out, make sure to like this video and don't forget to hit that subscribe button, as we continue to bring you insights from the world's top investors to help you become a better investor yourself.